Over 150 of the S&P 500 companies are reporting earnings this week, and Tuesday saw some amazing surprises with some shocking results. Some stocks crashed, some stocks rallied, and one stock fell 27% on the day, only to turn around and rally 40% after hours. Now, despite all of the madness, I made money trading today. I want to show you guys how I made money during this extremely volatile earnings season so that hopefully you can make money as the earnings season goes on. Now, let's get started with the earnings that came out on Tuesday. Then I'm going to get you prepared for everything that's about to happen on Wednesday. We get things started with General Motors, who raised their full-year guidance and announced deeper cost cuts. Still, shares fell 3.5%. The stock was initially higher in the early morning results, but then Wall Street analysts questioned the company's rollout of their new EV amid a supplier issue. So GM is struggling with the same thing that a lot of these automakers are struggling with, is they're having trouble getting their EV line of cars off the starting line. There's been a lot of disruptions with supply chain issues, manufacturing issues, battery fires. It's just very, very difficult to build a good EV vehicle. So obviously Tesla certainly has the lead, the early mover advantage, and they've got everything going for them for the time being. Time will tell if these other manufacturers such as GM can turn things around and figure out all the issues and start producing some decent EV vehicles. But for now, it's definitely Tesla is in the lead and they've got the advantage. So in the short term, definitely it's just going to be a long, hard road for GM, Ford, and many others to get their EVs off the ground. But I think long term, once they get it all figured out, things will turn around and the EV market will start to equalize a little bit and it won't be so heavily dominated by Tesla. But for now, certainly Tesla's the lead, and it looks like they're going to be in the lead for a while. Moving on, Spotify shares fell 14% on a revenue miss and weak guidance. Now, what's interesting is that revenue was up 11% year over year, but analysts were expecting revenue to be up even more. Monthly active users were up 27% year over year, and paid subscribers were up 17% year over year. So if revenue was up 11%, monthly active users were up 27%, and paid subscribers were up 17%, why did Spotify shares drop by 14%? Well, this is where you have to understand that there is a major difference between a company increasing revenues, monthly active users, subscribers, deliveries. None of that actually matters for a company that should be growing profits. And at the end of the day, Spotify just could not grow their profits. Spotify posted a net loss of 302 million euros, more than double the 125 million euro loss it posted a year ago. So this shows you why it is so important to focus on earnings growth and not focus on deliveries or subscribers or monthly active users or revenue or any of that. Because a company could have insane revenue growth, but if they do it at a loss, what's the point? They're just giving away their product for free. At the end of the day, what investors really want to see is that earnings growth. They want to see profits going up, because that ultimately is how companies make money, and that is how companies can ensure that they're not going to have to do share offerings or raise capital or do other things that might hurt shareholder value. So don't get all googly-eyed when a company reports incredible revenue or they report incredible monthly active users or huge subscriber growth or a huge increase in deliveries. Don't worry about any of that, because at the end of the day, what really matters on these stocks is that earnings growth. The margins matter way more than the actual increase in revenue. In another horrible earnings, Snap shares plunged more than 16% on a weak forecast. Sadly, Snap's sales also declined 4%. And despite beating earnings, Texas Instruments stock fell as their forward guidance fell short. Despite some of the early stocks crashing after reporting earnings, it wasn't all bad news. Some stocks did go up. Visa shares rose as their earnings benefited from a resilient consumer spending as travel rebounded. Visa Inc. called out robust spending trends as the payment technology giant topped earnings and revenue expectations for the latest quarter. So what's interesting is that we're seeing a lot of these companies say that their advertising revenues are declining, or at the very least, they're just not growing as fast as they once were. We are seeing margins come down as companies do whatever they can to keep consumers spending at their stores. We're seeing profits go down. At the same time, we're seeing revenues go up. So what Visa really showed us is that consumers continue to spend, but the profits are going down because margins are going down. So even though consumers are spending and revenues continue to be great at a lot of these companies, because they've had to lower their prices in order to get consumers to continue to spend, their profits just aren't doing that well, which is great for stocks like Microsoft and Visa, which make money so long as consumers spend, but it's not so good for a lot of the other consumer stocks, especially retail, who's going to be reporting here in about 2 weeks. And now moving on to the big two, let's start with Alphabet. Alphabet reported better than expected quarterly results, driven mainly by a growth in their cloud revenue. Alphabet shares rose as much as 7% in extended trading on Tuesday. Earnings came in at $1.44 versus $1.34 per share expected. Revenue came in at $74 billion versus $72 billion expected. And the YouTube ads also beat analyst expectations, coming in at $7.67 billion versus $7.43 billion expected. Cloud beat expectations as well, coming in at $8.03 billion versus $7.87 billion expected. And their traffic acquisition costs did come in a little bit higher than expectations, though, which hurt margins and profits a little bit at $12.54 billion versus $12.37 billion expected. Now, those are some incredible results, and Google stock rallied after hours for all the right reasons. Not only did they have an incredible earnings beat, their forward guidance came in quite good as well. Now, even though all that's true, one thing we have to understand is that as the Federal Reserve continues to raise interest rates, the growth from these tech stocks just is not going to be the same as it was for the past 15 years. See, from 2009 through about 2022, the interest rates held steady at around 0%. And for that 13-year period, the tech stocks especially were able to take advantage of those extremely low interest rates, and they were able to grow their companies exponentially at rates that we haven't seen since pretty much coming out of the Great Depression. Now, what's interesting about this is that now that interest rates are back above 5%, and companies are forced to borrow at anywhere from 8 to 15%, just depending upon their credit rating, what this does is it's going to significantly slow down growth. And that's what we've seen from Google. Most likely, these companies are going to grow at the rates they were doing before 2008, meaning they're going to be growing much slower. And the insane 50% per year growth that we saw over the past few years, it's just not going to be the case going forward. And this was probably very clear on both Microsoft, but also clear with Google as well. For the fourth straight quarter, Google's parent company reported growth in the single digits as it reckons with a pullback in digital ad spending that reflects concerns about the economy. Analysts do not expect growth to hit double digits again until the fourth quarter. Of course, that assumes that we don't enter a recession. Still, Alphabet did post a 7% growth for Q2, which was better than analysts had expected. And as you can see on the chart, that growth has rebounded from the lows from Q4 of 2022. Now, of that 7% in revenue growth, most of it was in Google's cloud unit. Revenue in Google's cloud unit, which includes infrastructure and productivity apps, increased 28%. Google's ad revenue only rose 3.3%, although YouTube ads did come in above analyst expectations at $7.67 billion from $7.34 billion a year before. Now, ad revenue coming in at 3.3% is not good. I mean, it's good, it increased, but it's nowhere near good enough to maintain the kind of forward PE ratios that we've seen. Thank God for Google's cloud business increasing to kind of help out the decrease in the ad revenue growth. Otherwise, we would not have seen the kind of rally in GOOG and GOOGL after earnings that we did in fact see. So unfortunately, when we look at other stocks that rely heavily upon advertising revenue, such as Amazon, this created a little bit of a scare, which I'll talk about in a second. As of the recording of this video, Alphabet stock was up about 6% after hours. Now let's talk about the big dog, Microsoft. Microsoft earnings topped estimates, but as I explained in yesterday's video, it would really be that earnings call that would really matter. The stock initially fell about 1%, but then got back to even right before the earnings call. Now, what's interesting about Microsoft is that even though Google grew their cloud revenue faster than expected, Microsoft's Azure cloud revenue growth slowed. A slowdown in the rate of growth of their cloud revenue combined with Google's slowdown in ad revenue sent a big scare to investors of Amazon. Amazon stock was down about 2% after hours after Microsoft and Alphabet reported earnings. Now let's talk about the details of Microsoft's earnings. Microsoft shares dipped after their quarterly revenue guidance missed expectations. Kind of like Tesla, Microsoft beat earnings, but the stock still went down. Earnings came in at $2.69 per share versus $2.55 per share that analysts were expecting. Revenue came in at $56.19 billion versus $55.47 billion that analysts were expecting. So it was a beat on earnings and a beat on revenue. But once the earnings call got started, Microsoft started to sell off. On a conference call with analyst Amy Hood, Microsoft's finance chief called for an 8% growth as forward guidance, which fell short of the $54.94 billion consensus amongst analysts. Analysts were looking for about a 9% growth, and they only forecasted 8% growth. That means growth has now come under 10% for 3 consecutive quarters for the first time since 2017, and forward guidance shows growth will come under 10% for a 4th consecutive quarter when Microsoft reports next quarter. So just like Alphabet, Microsoft is showing that as interest rates go up, the growth of these mega cap tech stocks is going down. We're not going to see the major insane growth like we've seen over the past 13 years. We are in a new era, well, really an old era, the kind of era we were in prior to 2008, where growth was a lot slower. And the fact is, tech stocks growing at less than 10% per year might become the new norm, and investors are just going to have to get used to this. Azure revenue grew 26% during the quarter compared to 27% from the previous quarter and 40% from a year ago quarter. So it's still growing, it's just not growing as fast, which again points to a slowdown in growth amongst these tech stocks. The slowdown in growth was attributed to concerns about a worsening economy as organizations using cloud services from Microsoft, Amazon, and Google have taken time to adjust their existing workloads to reduce costs in the past several months. Now, one thing that was going to be very important to hear from Microsoft was their AI development and how AI might grow and how that might attribute to revenues as well as profits. Unfortunately, the earnings call fell a little bit short and disappointing in this area. Microsoft's Azure OpenAI service that companies can use to access language models and other developer tools now has over 11,000 customers, up from 4,500 in May. That is a good growth in customer count, but like I just said, revenues and customers don't really matter. What matters is profits. And Hood said that as Microsoft invests to meet rising demand for AI services, the company should see more impact from higher revenue from them in the second half of 2024 fiscal year than in the first half. Now, that growth rate is really, really good. Unfortunately, the amount of money that Microsoft is charging isn't going to have a huge impact on their overall revenue, and AI is still expected to be a loss because the investment in order to host AI is going to exceed the amount of revenue they're going to bring in. So losing money on AI is to be expected at first, but what they said on the earnings call next, investors really did not like. Microsoft said growth from our AI services will be gradual. Certainly, investors were hoping for Microsoft's growth in AI to be much faster than that. And coming out and saying that the growth was going to be slow and gradual means that Microsoft is going to be running at a loss for a lot longer than investors would have liked. And that helped contribute to the downward pressure on Microsoft stock after hours. As of the recording of this video, Microsoft stock was down over 3% after hours. So that's what happened on Tuesday. Now let's talk about what you can expect for Wednesday. Meta is reporting earnings Wednesday after the close, and Meta stock picked up an upgrade ahead of earnings. But again, just like Microsoft, AI is going to be the biggest driver. So much like Microsoft, people are going to be looking at Meta's earnings to see how they plan to implement, develop, and most importantly, sell AI in the future. Now, don't forget that in addition to Meta earnings on Wednesday, we also have the Fed meeting. I know, with all these earnings, the Fed meeting kind of gets overshadowed and lost. Investors really aren't expecting a big surprise or a big movement from the Fed meeting. There's a 99% chance that the Fed is going to do a 25 basis point rate hike based upon CME futures. And Jerome Powell is widely expected to indicate another pause next time, as well as just say that they're going to be looking at how the data comes out in the future to determine what interest rate hikes are going to be necessary in the future. There's really no big surprises expected from the Fed meeting. And this is one Fed meeting that is just completely overshadowed by earnings. Still, you should be aware that this is a thing. And Jerome Powell is speaking on Wednesday at 2 p.m. Eastern Time, or about 2 hours before the market closes. Now, moving on to the other stock market news, RTX tumbled after disclosing engine manufacturing issues on some A320 planes. RTX's Pratt & Whitney unit makes the engines, and RTX cut its 2023 free cash flow outlook by about $500 million due to the issue. The stock was down about 10% on the day. And Wells Fargo announced a $30 billion buyback, causing shares to rise 3% in extended hours trading. And while everybody was focused on earnings, people overlooked the fact that the banking crisis worries showed up again as fear came out that Pacwest might collapse. There was an announcement near the close, a little bit before the close, while the markets were still open, that Pacwest was being bought out by Bank of California. And this caused a lot of people to worry that Pacwest was about to go bankrupt, and shares of Pacwest plunged 27% on the news. Regional banks across the board sold off as well. Then, after the close, the Pacwest Bank of California deal was confirmed and details were released, and Pacwest stock rocketed nearly 40% after Bank of California confirmed their plans to buy the troubled bank. It was a wild and volatile ride for Pacwest shareholders, down 27% on the day, only to recover all of the losses and rally about 35% after hours. Now, more mergers and acquisitions of banks were to be expected. We'll have to keep our eye on this to see if any other banks truly are near collapse, or if this was just a one-off deal that is really going to be very beneficial to Pacwest shareholders and other regional banks if we can get more of these buyouts that might prevent future bank collapses. So this could be a really good thing in the future, but it is something we're going to have to continue to keep our eyes out for. And in other news, IMF raised their global growth forecast despite China's recovery losing steam. In the latest update to the World Economic Outlook, the IMF raised the 2023 global growth prediction by 0.2 percentage points to 3%, up from 2.8% in its April assessment. However, they did keep their 2024 growth forecast unchanged at 3%. That news this morning sent global stocks up, but it's important to understand that while the economy is very strong right now, there are a lot of signs that there might be trouble on the horizon. Now, when that trouble comes, nobody really knows. Some people think 6 months, some people think a year, some people think longer, but there are still a lot of indicators that troubles are still on the horizon. And one of those indicators is that companies continue to do layoffs. Biogen is going to cut 1,000 jobs in order to save costs as they prepare for a launch of their new drug. So amongst all this madness, how did I make money today? Well, very simple. I bought basically 2 options today. One of them was a call option on Google, and the other one was a call option on the QQQ, which is a NASDAQ 100. And in order not to just completely gamble, I bought both of those for the August expiration. So they're both about a month out. Now, I told my Discord members that I was originally thinking about doing a credit put spread on GOOG, which would have been fine, probably a better option, less risky. But in the end, I decided to go with the straight call and do it a month out. And it worked out great. So tomorrow I'll have to update you and show you guys how much profit we made on that. Now, as we get into Wednesday and talking about Wednesday earnings and how to play it and everything, my guess is that after Jerome Powell speaks around 2 p.m., we'll see a little bit of a rise in the stock market as whatever fears or concerns about what the Fed might do sort of get laid to rest. And we might see a little bit of an increase in the stock market, maybe 1% or so in the NASDAQ, for example. And then after that, though, I'm looking at, of course, Meta earnings is going to be the big one that everybody's focused on. Now, as far as what Meta does after earnings, I literally have no idea. This is a stock that could go up if ad revenue is increased, but based upon what Alphabet reported, it doesn't look like there's a lot of advertisers that are really coming back into the game. So that might put a little bit of downward pressure on Meta. At the same time, Meta might be able to rise on some AI hype, but based upon what Microsoft put out, it doesn't look like there's a lot going on for that as well. So Meta is one of those stocks, I don't really see it moving a lot after hours. I don't really see it going up a lot or down a lot. Now, of course, we could always have a surprise, but at the current time, just based upon what Alphabet and Microsoft reported, I just don't see a big movement there. So for Meta, I might consider an Iron Condor. And an Iron Condor essentially makes money so long as Meta doesn't have a major move up or down. If it does what Microsoft did and only goes about 3 or 4%, an Iron Condor will make money. Now, if it does what Tesla did, it moves 10%, an Iron Condor is going to lose. But so long as it stays less than a 5% move, an Iron Condor will actually make money. And it doesn't even matter if Meta stock goes up or down. The Iron Condor makes money either way. And to do an Iron Condor, you're essentially just doing a credit put spread and a credit call spread at the same time. And basically what you want is for each of those to go to 0. And so long as they do, you end up making money. So when it comes to Meta, if I was going to play it tomorrow, I'd probably do an Iron Condor. Most likely, though, I'm not going to be playing Meta earnings. I'm going to sit that one out. but that's how I would play it and try to make money if I was going to play earnings tomorrow. Now, if you don't know what an Iron Condor is, you don't know what a credit call spread, credit put spread, all these things are. These are all different ways to make money with options by selling options rather than buying options, which is a far more profitable strategy than just buying single leg calls and puts. And if you want to learn these more complicated strategies so that you can make money no matter which way the stock market goes, for example, making money on Meta, whether it goes up or down, you make money either way. If you want to learn these more complicated strategies, I will teach you how to do it. All you got to do is join my coaching program. I'll show you how to actually do these plays and set them up and make money with them, as well as giving you my trades that I'm making. If you're interested in joining the coaching program, you want to make money with us, you want to learn how to trade options like a professional, then schedule a call with my onboarding specialist. All you have to do is go to weprofitdayandnight.com and click the Start Learning button to schedule that call. Again, weprofitdayandnight.com to schedule a call with my onboarding specialist and get more information about the coaching program. If you get a lot out of this video, then be a good friend, share this video with your friends and family and on your social media pages so that others will know what to expect for the market on Wednesday, as well as understand what happened on Tuesday. And don't forget to hit the like button and subscribe. And if you missed yesterday's video where I went into a little bit more details on the Fed and what to expect for the rest of the week, make sure you watch yesterday's video here.